Welcome to the latest edition of Virtual Investor Series. I'm Spencer Wilson, Director, Business and Relationship Management, APAC. Today I'm joined by Chris Stankovski, Senior Director from our Structured Finance Ratings team. And we're going to discuss Australian RMBS. Welcome, Chris.
Thank you.
I'd like to start with interest rates. We're in a rising interest rate environment. How borrowers to rising rates in the pools that we rate?
Well, there's a lot to unpack there, Spencer. So I think we might start with interest rate forecasts. As you'll be aware, the Reserve Bank of Australia raised interest rates, the cash rate by 50 basis points yesterday, in the September meeting, taking the cash rate to 2.35%. Market consensus is that the Reserve Bank has done a lot of the heavy lifting in this interest rate cycle, as the market believes that the cash rate will peak around 3% early next year. We haven't seen the cash rate 3% since 2013, and back then, mortgage balances were a lot smaller than they are now. With the cash rate at 3%, we expect that the mortgage rate would be 5.5% for owner-occupied and 6% for investor loans, floating rate loans next year. At this rate, it's interesting to see how vulnerable borrowers are to those interest rates, and a good way to start there is looking at the assessment rate that was conducted when the loans were originated. From the end of 2014 to mid-2019, the assessment rate that was used on mortgages was a floor of 7.25%. I think it's fair to assume that mortgages that were originated during that time would be able to absorb the interest rate increases. Since mid-2019 to October 2021, the assessment rate used by lenders was the mortgage rate plus a buffer of 2.5%, or the floor rate that's applied by lenders, the higher of. According to APAC data, the floor rate applied by lenders in late 2019 was 6%, and it got down to 5.4% in late 2021. So if you assume that the floor rate was used to originate all loans, which it isn't, but if you assume that, the assessment rate's gonna be pretty close to what we expect the mortgage rates to be next year. From October 2021 onwards, that buffer rate had increased to 3%, and we've also seen lenders increase that floor rate. So when we assess the vulnerability of borrowers, we think that there's a specific cohort that's more vulnerable than others, and they consist of the following three characteristics. One, we expect that the borrowers who originated around 2021 will be vulnerable because they had a lower assessment rate buffer. And if those borrowers are also maxing out their servicing capacity, which means they're taking away any additional buffer, and if these borrowers have none or limited savings in order to be able to meet repayments. Other than that specific cohort, we generally think that borrowers will be able to make the higher interest rate payments of 5.5% and 6%.
What type of borrower behaviour have you observed as mortgage rates have been rising?
So as mortgage rates have been rising, we've seen that the prepayment rates or refinancing rates have also increased. We've seen borrowers looking into the market to get a better rate. And this affects their serviceability in two ways. One, if a borrower moves to another lender and gets a lower rate, it actually reduces their monthly repayment exposure. And also, the borrowers, when they refinance an existing loan term to a 30-year loan term, they've got longer to repay the loan, and so then the borrower repayments also reduce, which is positive for their serviceability assessments.
Thanks, Chris. I'd like to move on to collateral performance. What is Fitch's forecast for the remainder of this year and going into 2023?
So looking at arrears is quite interesting. So we know that interest rates affect the borrower's serviceability, but when it comes to mortgage performance and talking to lenders out there are four kind of life events that have a big impact on mortgage performance. One is whether the borrower or related party has had a significant health issue. Second one being whether there's been a death of the borrower or the family. Third being relationship breakups, and fourth being unemployment. So assuming that health, death, and relationship breakups aren't strongly correlated to the cash rate, we'll see that the unemployment will be the biggest driver for mortgage performance. Unemployment currently is quite low, sitting at about 3.4%, and the forecast over the next year or two is that unemployment might increase to 4%, but that's still quite a low number. Based on this low number of unemployment, we don't see a dramatic spike in mortgage performance or delinquency, and we don't see a great spike of defaults either. The current arrears rate's quite low. Our most recent income that just recently came out had the 30 plus arrears of 0.8%, and that's a historical low. So we expect that to increase to levels that are more in line with long-term averages. We expect that some borrowers who are in that cohort that might have difficulty making mortgage repayments might make $1,900 of a $2,000 mortgage repayment. And in that scenario, we expect them to kick up their arrears levels. But when someone's making a partial repayment, being partial, the majority of the repayment, we don't expect that the lenders will default that particular borrower. So although we expect the arrears to tick up, we don't expect there to be any material increase in defaults for mortgages. Having said that, the downside risk is that the Reserve Bank is not able to execute their soft landing in trying to control inflation, and unemployment kicks up significantly above 6%. If that was to occur, then we would expect to see a significant deterioration in mortgage performance and increase in mortgage defaults. This isn't our base case, but we are keeping an eye on the market just in case this eventually does happen.
Just wanted to focus on lenders. How might lenders react to rising arrears? Will they pivot and tighten credit?
So there's two ways to look at that. One way is, how does the current underwriting standards affect credit? And so the current underwriting standards is that they look at the mortgage rate plus a buffer of 3%. So if you look forward to next year and you assume mortgage rates, just for nice round numbers, is 6%, when you add a 3% buffer on that, mortgages will be assessed at 9%, assuming APRA doesn't come in and reduce the mortgage rate buffer at that point in time. So assuming it doesn't, that's a really large hurdle, and that in itself has an impact in two ways. One, impacts the amount of borrowers who can get new finance in order to purchase properties and the like, and also has an impact of potentially creating more, as the term goes, mortgage prisoners. You know, borrowers who currently have a mortgage, but will find it difficult to refinance out because they can't meet their serviceability hurdle. And if that should play out, we'd expect that the refinancing rates in the second half of next year would actually slow down, taking this into consideration. If we were to see a stress in the market and to see pockets of mortgage arrears and defaults more higher than what we expect, typically the way we expect the lenders to respond that would be to tighten credit in those particular areas. So for example, during the financial crisis, we had seen some lenders tighten credit with regards to SME lending for cafes, restaurants, gym owners and stuff like that. So they tend to respond that way, but I think the majority of the tightening of credit is inherently inbuilt in the buffer rates that are applied for mortgage servicing.
I'd like to cover the housing market. We're starting to see falling house prices. What's the likely impact on the RMBS portfolio?
Yeah, that's a good question. So I'll tackle that first by, whenever I like to talk about house price forecast, I think it's very important to look at what's happened in the lead up to where we're making the forecast. So since mid-2019 to April 2022, house prices have increased 37%. So that's quite a material increase. And so the market consensus is that from April 22, house prices may fall approximately 15% from their highs. If that was to happen, house prices will fall back to levels we last saw in March 2021. So taking that into consideration, when we look at securitization, we're not only looking at the movement in house prices, we're also looking at mortgage defaults. So for a mortgage to take a loss, first that mortgage has to default, and then the property that's related to that mortgage has to be sold at a value that's lower than the mortgage balance. As we expect mortgage defaults to be quite low over the next 12 to 18 months, we expect that losses that will come through securitization transactions also to be quite low. Should mortgage defaults increase above our expectations, then the cohort of borrowers that are most likely to take a loss would be borrowers who had a valuation that was after March 2021, which means that their house price decline would affect they may potentially be below where the original valuation was, would be a borrower who had a high LVR, so that way had a little bit of equity in the deal, and a borrower who hasn't got much buffer capacity, whether it's in the income that they earn or whether it's in savings.
Are there any particular markets that are more vulnerable than others?
So with regards to the mortgage defaults, we're not actually seeing any pockets that are more vulnerable than others because the unemployment rate is quite low across the whole country. We're not seeing any specific state that has a significantly higher unemployment rate than the other. With regards to house price decline, the consensus is that Sydney and Melbourne are going to lead the house price declines and may decline a bit more than the national average. And the consensus also is that the premium suburbs might decline more. And this isn't necessarily just in this particular market. We generally see the premium suburbs, when there's house price declines, they fall first, they fall deeper, and when there's house price appreciations, they move first and they rise larger. So that's consistent with our historic view.
Thanks, Chris. We're starting to see stress permeate through the economy. If unemployment was to rise, are there any pre-existing liquidity buffers in place at the moment?
Yeah, so RMBS structures themselves have a couple of features that help absorb losses before the losses get passed on to note holders. So one of that is the use of excess spread. So in RMBS transactions, money that would have been available to income unit holder gets diverted should there be any mortgage losses to fund those mortgage losses and to make the note holders whole. So based on that feature, RMBS transaction inherently can take a mild stress before any losses go through to the note holders. There's also a second feature that helps buffer note holders who have a rating, and that's the performance triggers based on prorated payment. So these performance triggers suggest that should arrears go above a predefined level or should not get charged off, transactions that in a pro-rata payment will go back to sequential payment. And what this does, it builds up the credit enhancement that supports the rated notes and provides more buffer for those particular notes. When we look forward to the rest of the RMBS transactions, we see transactions that are more seasoned have been more protected against a downturn than newer transactions. And that comes mainly down to four main reasons. The first reason is for a seasoned RMBS transaction, we have this deleveraging impact on the mortgages. As the longer the mortgages are there, people make more principal repayments, the loan balance goes down, there's more equity in that particular mortgage, and there's more loss absorbing equity to take to offset any losses should they default and house prices fall. Second one is when those loans were originated, those loans were potentially originated with a higher servicing buffer because either the mortgage rate that they were first originated was higher or they were prior to 2019 and they had that 7.25% servicing floor applied. Third one is that because they were originated a while ago, they would have had some house price appreciation added to their particular properties before the house price decline comes in. And fourth is those particular RMBS transactions have had time to build up credit enhancement. So generally, in RMBS transaction, the first couple of years is sequential payment. And so you see a build up of credit enhancement to the rated notes, which then provides more support to that particular rating. The newly originated transactions don't have those benefits yet, and so they are potentially more susceptible to market softness. It's worth noting that in our RMBS criteria, we do apply own market value declines when we are rating the transactions. And at the single B level, the average market value decline is 34%, and at AAA, the average market value decline is 55%. So those market value declines are higher than the projected house price declines that are in the market, and they're built into the ratings. So it provides at least that base stress into the ratings.
Thanks for your insights, Chris, and thank you for joining us. For more information on Australian RMBS, please visit us at fitchratings.com. If you have any questions on the topics we discussed, please send an email to the address on the screen.